Hi, I'm Seth Freudberg. I'm the Director of Options Training here at SMB in Manhattan and head trader on SMB's Options Trading Desk. This week, I'd like to talk about what I call the two modes of options income trading. And basically, the way I see it, there are two types of options income traders. Those who try to control their options Greeks, in other words, delta, vega, and gamma, so that theta, time decay, can be the most significant Greek, and the other Greeks, which constitute the risk of options income trades, are minimized. So those are what I call Greeks-based trading strategies, where you adjust them and set them up initially to minimize risk. The second broad type of options trading mode that you'll see in the market is what I call statistical trades, which are trades which you allow the probabilities of the options chains to come out over time through simply leaving the trades alone, not trying to adjust them, not controlling the Greeks, but instead allowing the statistical edge of time decay to work in the favor of the options trader. So let me give you a real simple example, and it's actually something we're trading on our trading desk right now, and that is a 45-day iron Condor that one of our traders here has developed. He based it on some research that was done and came up with his own homegrown iron Condor trading technique, which so far so good. And the point is that it is based upon the statistics of backtesting that he did using this one iron Condor strategy with one or two very simple principles. Number one, you start the trade where the short strikes are at 16 deltas, so you've got a decent width of your iron Condor. Number two, the long strikes are 30 points farther out of the money. Number three, there is therefore roughly a 68–70% probability of profit on the trade, and the backtesting shows that if you just slap the trade on and leave it on until 50% of the credit has evaporated through time decay, and you take the trade off basically with a 50% profit of that credit, then you are going to have very, very high win rate on the trade. Of course, it's going to lose, but periodically. But the win rate that we've been seeing in the back tests is north of 80%. So if you did this monthly, you should win 9 to 11 times a year, basically, is what the statistics would say, and only lose 2 or 3 times a year. And the P&L, by the way, against the capital being used is nicely above 50%. So it's an interesting strategy. And here's an example just to kind of give you a sense of it. This would be one you would put on for November, starting 45 days out. You're short the 1210 calls and you're short the 1040 puts, and the credit you'd receive here would be $613. And here's a sort of a visual display in option view of how wide your profit area is. So you can see there's probably a pretty good chance that the Russell 2000 index by November will close somewhere in between those 2 points in the green section of this graph, which shows profitability. So basically, what we're saying is it's a trade that if you leave it alone, you don't get too worried about what's happening with the market price. The market price could even blast through the short strikes, but a pullback into the body of the iron Condor before expiration does the trick most of the time. Not all the time, as I say, you're going to lose a certain number of times a year on this trade. So this is a statistical trade. You don't touch it, you leave it alone, you let the width of the iron Condor play itself out. And if you get to a 50, and a key is if you get to a 50% profit on the credit, you close the trade, which saves you from big moves which may occur after you have closed the trade. So what's interesting is the same trader who developed this thought about trading it weekly instead of monthly. So he ran another back test, and he basically entered the trade 63 days, away from the monthly expiration, then 56 days, 49 days, 42 days, and 35 days. And then started into, as soon as that month got less than 35 days, he moved into the next monthly expiration. So he was putting the trade on every week, which meant you'd have overlapping trades throughout the year. And what he found was interesting. The returns stayed very, very positive, but they smoothed out from year to year. So one year, which would be maybe a break even or maybe even a loss year, would turn into a mild loss or a mild gain. So the width of the returns got a lot tighter. In other words, if you're putting this on once a week instead of once a month, you got so many much more data points that the true probabilities of the trade come out, and the true probabilities were very, very favorable. So we have decided to go with the weekly approach as opposed to the monthly approach, because it basically gives the probabilities more data points to prove out the validity of the trade. So this was what is very different trading style than many traders trade. It's called a statistical trade as opposed to a Greek space trade, but it's equally valid. Some would argue more valid. Some feel that the Greek space traders fuss with the trades too much, fool around with them, and ruin the trades, whereas the statistical traders just allow those statistics to come out. It's an argument that will probably go on forever, but it is certainly a different way of looking at options income trading. So I hope you got some insights into the two different modes of options trading, options income trading, Greek-based and what I would call statistical-based trading. Hope you learned something, and we'll catch you next week. Thank you.